Real quick, what if I told you the Federal Reserve is literally about to make everything more expensive for you? Your car loan. Your credit card. Your rent. All of it. And the crazy part? Just 2 days ago, Wall Street thought this rate hike wasn't even going to happen. Then oil prices spiked overnight, and suddenly the odds jumped from 17% to nearly 50%. So in this video, I'm going to break down what a Fed rate hike actually means, why it's happening right now in July 2026, and most importantly, what you should do with your money before it hits. If you have a credit card, a car loan, or even just a savings account, you need to watch this. Let's go. Okay, so first things first, what even is the Federal Reserve? Think of the Fed as basically America's financial boss. One single organization that has the power to make borrowing money cheaper or more expensive for every single person in the country. And they do that by controlling something called the federal funds rate, which is the interest rate that banks charge each other when they lend money overnight. Now I know that sounds super complicated, so let me give you the simplest example possible. Imagine you and your friend both have lemonade stands. You run out of lemons, so you borrow $10 from your friend to buy more. Your friend says, "Okay, but pay me back $11 tomorrow." That extra $1? That's interest. Now the Fed is basically the person who decides how much that interest has to be. When they raise the rate, your friend starts charging you $12, $13, $14 instead of $11. Borrowing gets more expensive. And here's the key thing, when banks have to pay more to borrow from each other, they pass that cost directly to you. So your credit card starts charging more. Your car loan gets more expensive. Your mortgage rate goes up. Right now the Fed's rate is sitting at 3.75%. And there's a very real chance they bump it up to 4%, possibly as soon as July 29th. That's literally 2 weeks from today. So why is this suddenly back in the news? Let me walk you through exactly what happened this week, because it's actually a wild story. Monday morning. The US and Iran started exchanging attacks in something called the Strait of Hormuz. Now if you've never heard of that, the Strait of Hormuz is basically a narrow stretch of water between Iran and the Arabian Peninsula. And here's the crazy thing about it, about 20% of all the world's oil passes through that one tiny waterway. 1/5 of the entire planet's oil supply. So when things get dangerous there, oil traders freak out. They start thinking, what if the supply gets cut off? And when supply might go down, prices shoot up. On Monday alone, oil prices jumped over 9% in a single day. That is a massive single-day move. Now let me show you why that matters to your everyday life with a quick example. Let's say a trucking company ships oranges from Florida to a grocery store in Ohio. That truck runs on diesel, which comes from oil. When oil prices go up, diesel gets expensive. So the trucking company has to charge the grocery store more to deliver those oranges. And what does the grocery store do? They raise the price of oranges. So now you are paying more for oranges at the checkout line, not because of anything you did, but because of a conflict happening halfway across the world. That's how inflation works. One price goes up, and it ripples through everything. And inflation is the Fed's #1 enemy. Because when prices keep rising, the Fed feels pressure to raise interest rates to cool things down. Now on Tuesday, there was actually some good news. June's CPI report came out. CPI stands for Consumer Price Index, it's basically the government's report card on inflation. How much did prices rise this month compared to last year? And the number came in at 3.5% annually. Which sounds high, and it is, but it was actually lower than the 3.8% that experts were expecting. So the market got relieved. Rate hike chances dropped from 42% down to 17%. Stocks bounced back up. Nasdaq was up over 1%. But, and this is a big but, oil prices are still elevated. The situation in the Middle East is not resolved. And the Fed's own governor came out and basically said, if inflation keeps showing broad price pressures, we will raise rates. So the bottom line? A rate hike in July is less likely now than it was 48 hours ago. But a rate hike in September? Traders are still putting nearly 60% odds on that. It is coming. The only question is when. Okay. Now this is the part that actually matters to you personally. Let me break down what a rate hike means for each situation you might be in, and I'll give you a real number example for each one so it actually makes sense. Let's start with credit cards, because this is the most urgent. Credit cards have what's called a variable interest rate, meaning it moves up and down based on what the Fed does. Most Gen Z credit card APRs right now are somewhere between 20% and 29%. That is already brutal. A rate hike of even 0.25% pushes that higher. Here's the example. Say you have $3,000 in credit card debt at 24% APR. Every single month, you're paying about $60 just in interest, before you even touch the actual debt. If that rate goes to 25% after a hike, now you're paying $62.50 a month in interest. Doesn't sound like much, right? But over a full year that's $750 in interest alone, just for carrying that $3,000 balance. You're basically paying $750 for nothing. And if you only make minimum payments? That $3,000 could take you over 10 years to pay off. I'm not making that up. That's just how compound interest works against you. What to do, if you're carrying a credit card balance right now? Make paying it down your number one financial priority before rates go up. Even throwing an extra $50 or $100 a month at it makes a real difference. Or look into a balance transfer card with 0% APR for 12 to 18 months, that buys you time to pay it off without interest piling on. Next, car loans. Auto loan rates are already pretty rough right now. The average interest rate on a new car loan is sitting around 7 to 8%. A rate hike makes that go higher. Here's the example. Say you want to buy a $30,000 car. At 7% interest over 5 years, your monthly payment is about $594. Total interest paid over those 5 years, roughly $5,640. Now say the Fed hikes and your rate goes to 8%. Same $30,000 car, same 5-year loan. Monthly payment becomes $608. Total interest? $6,480. That's almost $850 more that you're paying just because of a 1% rate difference. On the exact same car. What to do, if you genuinely need a car in the next few months, buying sooner before another rate hike could save you real money. If you can wait, wait. And always consider used cars, because you can often negotiate the price down more aggressively, which reduces how much you even need to borrow. Now, mortgages. I know a lot of you might be thinking, I'm Gen Z, I'm not buying a house anytime soon. And honestly, fair. But hear me out, because this affects you more than you think. Mortgage rates right now are sitting around 6.5% to 7%. A rate hike keeps them elevated, or pushes them even higher. And this directly affects how much house you can afford someday. Here's the example. Say you want to buy a $400,000 home and put 20% down, so you're borrowing $320,000. At 6.5% interest over 30 years, your monthly payment is about $2,023. Total interest paid over the full loan, a staggering $408,000. You're basically paying for the house twice. Now if rates drop to 5% someday, same $320,000 loan. Monthly payment drops to $1,718. Total interest? $298,000. That's $110,000 less, just because of the interest rate difference. So even if you're years away from buying a house, what you do right now matters. Because the better your credit score when you apply for a mortgage, the lower rate you'll qualify for. What to do? Start building your credit score today. Pay your bills on time, keep your credit card utilization below 30%, and don't close old accounts. Every point you add to your credit score now could save you thousands of dollars on a future mortgage. And now the good news, because not everything about rate hikes is bad. If you have money sitting in a savings account, a rate hike actually works in your favor. Here's what I mean. Most people keep their money in a regular savings account at a big bank like Chase or Bank of America. Those accounts pay you maybe 0.01% interest. On $5,000, that's literally 50 cents a year. A year. That is insulting. But high-yield savings accounts, usually offered by online banks, these go up when the Fed raises rates. Right now, you can find high-yield savings accounts paying 4.5% to 5% annually. On that same $5,000, that's $225 to $250 per year. Just for having your money in the right place. Here's the math side by side. $5,000 in a Chase savings account at 0.01%, after 1 year, you have $5,050. 50 cents. $5,000 in a high-yield savings account at 4.8%, after 1 year, you have $5,240. That's $240 in free money. No extra work. No risk. Just choosing the right account. What to do? Move your emergency fund and any cash savings to a high-yield savings account today. Look up options like Marcus by Goldman Sachs, Ally Bank, or SoFi. All of them have been offering strong rates. It takes maybe 15 minutes to set up and it starts earning immediately. Alright, let's bring it all together with your simple 3-step game plan right now. Step 1, kill the high-interest debt. Specifically anything above 20% APR. That debt is costing you more than almost any investment can earn you. Paying it off is the best return on your money right now. If you have $500 extra this month, put it toward the credit card first. Step 2, move your cash to a high-yield savings account. This is the easiest, lowest-effort money move you can make in the next 24 hours. Your bank is not your friend when it comes to savings rates. Find a high-yield option and make the switch. Step 3, don't panic about the stock market. Yes, a rate hike creates uncertainty. Yes, some stocks will drop. But look at what just happened. JP Morgan, Goldman Sachs, Bank of America, Wells Fargo, all of them just reported their Q2 earnings and beat expectations. The economy is not collapsing. The Fed is just trying to keep inflation under control. If you're a long-term investor, stay the course. If you're not invested yet, rate hike periods are often when you can find stocks at better prices. The people who come out ahead in times like this are not the ones who panic, they're the ones who understand what's happening and take small, smart actions while everyone else is confused. That's it for today. If this video made the Fed rate hike actually make sense to you, drop a like, it genuinely helps this channel grow. And I want to know, which situation are you in right now? Credit card debt, car loan, saving up, or investing? Drop it in the comments. I read every single one and I might make a dedicated video on whichever comes up the most. See you in the next one. Peace.